On silver, on the other side of the chart, it's even easier. Again, we had a fake trigger. Silver has a little bit of a higher beta, stepped over the line, pulled back, and now you are reasserting in the red circle again to the upside. This is an incredible target, and we would expect it to be overperformed too. There's a critical moment for gold coming up right now. It's either going to be something of an upside move, and we're basing out a lot of times here, and then we're going to go and put a third high and continue to the upside, or we will fail and run that low. And I'm saying it will be negative for gold if we were to run this low here, which is at 2,624. So I think you're looking at a more sustained pullback if that happens. However, I'm not calling that until it happens. There's been a lot of dollar strength brought on by the rates going back up. The US debt market, it'll go universal. During this period, if rates get disorderly, the dollar will spike.
Silver has shown higher volatility, recently rising above a critical level before pulling back while attempting to regain upward momentum. Gold is at a crucial juncture, with the potential to establish a third high and continue its upward trend, though failing to hold above the $2,624 support level could trigger a sustained pullback. Additionally, recent strength in the dollar, influenced by rising interest rates in the U.S. debt market, may lead to volatility and a potential spike in the dollar's value. Overall, the market direction remains uncertain as developments unfold. The speaker, Francis Hunt, is a well-known financial analyst and trader, often referred to as the market sniper. He explains the historical context of silver and gold prices, highlighting the impact of monetary policy and geopolitical events on these precious metals. The narrative begins with the significant run-up in gold prices during the late 1970s, following the U.S. dollar's convertibility and the Vietnam War, which led to mounting debt, unleashing a gold rally that coincided with soaring interest rates to manage the debt crisis. This debt, rooted in military expenditures, continues to be a burden on citizens today, exacerbated by financialization and globalization, which kept inflation in check while demonetizing gold. It examines the market dynamics of gold and silver, noting their interconnectedness and similar trajectories. Francis Hunt recalls, after the 2011 peak, gold's potential was stifled by quantitative easing, which only worsened the underlying debt issues. A resurgence was noted around 2016 with the Shanghai Accord, but gold and silver faced a prolonged downturn before beginning to recover around July 2022. This overview underscores how historical events and monetary policies have shaped the current landscape of precious metals, highlighting ongoing challenges in managing national debt and inflation. If you're enjoying this video, please give it a thumbs up and subscribe for more content. Currently, only 11% of our viewers are subscribed, so help us reach our goal of 1,000 subscribers by clicking the subscribe button.
I've got the silver chart on the other half. These are 6 monthly charts. You've got to get a man who's lost his hair time frame into this whole setup. So it's 56 years that we're looking at. And this literally is the history of money destruction, rather than just being about gold and silver. You can see the big 80s run came in really hard, topped out January 80. That's no surprise to most people. That was post-Vietnam War. That was 64 through to 74. The meaty bits, the final piece was only in 74, but the meaty bits being 66 to 72, and more weaponry was used, and munitions specifically, than the Americans used in World War II. So this was a feast for the military-industrial complex at the cost of you, the citizen, where the debt got loaded up. And as a result, because the dollar was still convertible, you had a huge gold run that occurred after the 1971 initial delinking of Nixon that he was almost forced to do, that was meant to be temporary. And once that was unleashed, we had the gold run. Then we went into very high interest rates. Volcker raised rates painfully. The American farmers were coming to New York City, much like the French do, at a drop of a hat in Paris. So that's how bad it had to get to do that. And he turned up the pain to try re-establish and devalue the debt. When he raised the rates that far, what he was actually doing is devaluing the debt asset that had been raised and given on expenditure to the military-industrial complex to pay for the Vietnamese War. So see it in that light. And that's all been passed on you, and that debt is still there being rolled and continues to grow all this time. Then we had the financialization of everything. During this phase, we had globalization that kept inflation down. You had gold being demonetized. You had everybody getting into more finance, balloon payments on cars, only buying 40% thereof or 50%. All of this, oh, we don't need gold anymore. That was right the way into the dot-com boom that many remember, and that was literally tech dominating everything, and gold's, the legacy pet rock for old guys. Then we started, because of the debt levels that came with the recession of the dot-com, to see gold outperforming. Similar trajectory, same time frames, 1980. Silver bottomed a little earlier, but stayed in a stall box, while gold had a bit of a V bottom. So you can see they're clearly part of the same category of precious metals. Anyway, getting up to here, 2011 high, we recall that. I've referred to it regularly as this was a truncated bull that never was allowed to finish what it was starting. And that was because quantitative easing came in, we loaded all the debt, but by buying that more time, they almost made the debt an even bigger problem. So the subsequent pullback was not near as far. And when China became Shanghai Accord indebted, 2016 over here, we saw the debt issue reemerge, and we had the run to 2020, which was $2,075 for gold at that point. In that, this is a halves, so this is H2. Each one is a quarter. It's not the exact day. It was the second half of the year. And silver was following the exact same route. It was round about there. It got its pants on and started to follow gold. Then it got stopped. We then went into a holding period for quite extended time frame. Down, down, down. And in fact, we started to bottom at July 22 again.
Francis Hunt's discussion indicates that while there may be short-term recession fears, the market is likely to trend higher in the long run despite potential pullbacks. There's concern about the sustainability of increasing debt levels, as ongoing issuance may outpace demand. Although there's been a sideways movement in the bond market, the prediction leans towards an eventual breakout to the upside, which could create issues for real estate refinancing and consumer debt. Francis Hunt also highlights the precarious state of the debt system, as central banks like the Bank of England struggle with demand for their bonds, suggesting underlying vulnerabilities in the financial system that could lead to broader economic challenges. Francis Hunt, in his commentary, presents a grim view of the economy, describing the previous Goldilocks economy of low inflation and high liquidity as having ended, resulting in a painful reality marked by rising debt and financial instability. It emphasizes the need to preserve wealth through gold and silver and prepare for potential interest rate spikes and banking crises. The speaker, Francis Hunt, expresses concern about government intervention, suggesting that authorities may target personal assets like gold and even consider confiscation during financial turmoil. Ultimately, it calls for vigilance and readiness in an uncertain economic landscape. Let's have a look back at the interview.
All forms of debt instruments turning into a rout, and the second stage is worse. And for those of you familiar with Elliott, even if you take this as leg one and this is kind of pullback counter trend leg two, it's usually the third leg, which is again to the upside, that has the biggest 61.8 plus the previous leg's move. That is devastating for the way that all economies, because this will go universal, especially if it's happening in the US debt market, it'll go universal. During this period, if rates get disorderly, the dollar will spike. So this was a period of dollar strength because the Fed and the USA had to stay out in front on rate rises. And you saw what happened to Britain when they didn't match them. This sideways period, we've actually had the US cut, and you've had the UK and Australia saying, I'm not sure we will. You know, it's kind of soft and we could cut, but one of them actually said the quiet part aloud in the UK, that's Bailey. We're not sure, we don't want to test what the market will take. What that actually is saying is, if we drop rates, we're saying our bonds are worth more. And who's going to come in and buy it? And in actual fact, there was a tweet today where the Bank of England has said they are going to match banks' bids in the debt market. Why are they needing to do that if there's sufficient demand? Everything I'm telling you about the debt system being incredibly precariously upheld, if it's a dark phrase, remember we had the Goldilocks economy, where we could continue to print and have run high liquidity, and we were globalizing, and the core CPI stayed really low because everything was moving to China, Taiwan, Vietnam. Manufacturing was being hollowed out. You get a once-off gift of that. They ran interest rates too low. They increased debt and financialization. Everybody's average expenditures for things weren't going up at the typical inflation rate because you got this offshoring benefit. And now we have, that was the day where we feasted and we drank and we partied. And now you have the morning after with the hangover. And, you know, if you take heavy drugs, you're going to have heavy hangovers. And we're going to have the mother of all hangovers. So I'm not going to sugarcoat it if that's the truth. I'm assuming everyone's red-pilled enough to take the truth. So what do? Do you fall in a heap and weep and get totally psyched out? No, you preserve your wealth. And gold and silver, precious metals are absolutely going to be a cornerstone of that. You have to get out of the debt markets. You have to prepare or insulate your way the best way possible against an interest rate spike. Even though there's going to be up and downs and we're in the sideways period for a while more. I can't tell you whether it's 6 days, 6 weeks, or even as far as 6 months they can pretend. But I can certainly feel that there is a crescendo coming for this October period. Banks will be compromised. The possibility of loss of all deposits will be in there. We're talking a kind of an FTX experience for everybody. Imagine that. And the bailouts, the FDAs, the deposit schemes are there for one bank failure where the rest are paying a premium to make clients whole. There is no insurance that insures the world. There is just no insurance. And when you see the size of their funds, you will know that they're not even a little pippy in the ocean in terms of coverage. So forget about, don't worry, government will make me whole. Government is not your friend in times like these. They are going to come for taxation. They'll probably want you to register your gold. I've warned of this before. And we had controversial comments. I think it was about 1.5 years ago when I warned that just buying the gold isn't enough. You know, you might need to bear in mind how much of it will go black when they come to register. And I started putting forward all of these things, and they could even make it illegal, and they could at the final stage even come for confiscation. And now people said, he's just doomer, scaring us all. What did you see coming out of Israel? I don't think we've spoken since that. They will make gold ownership potentially illegal. So when everybody is doing their damnedest to survive this, they want to corner you. They need you to be a UBI serf, because that is the ultimate control. We're going into a period of totalitarianism. There is nothing good that comes out of a debt collapse for any of us.
The discussions highlight the complex dynamics of the gold and silver markets, the historical context of monetary policies, and the looming economic challenges driven by rising debt and potential government intervention. As investors navigate this uncertain landscape, focusing on wealth preservation through precious metals and staying vigilant about market developments will be crucial for mitigating risks and seizing future opportunities. How might rising interest rates impact the demand for gold and silver as safe haven assets? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first and then watch the video, and turn on post notifications for more videos like this. Until next time.